Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cashflow podcast, where our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. And our guest for this week's show is real estate investment expert James Kandasamy. Now, James is the founder and CEO of Achieve Investment Group, a multifamily investment group based in Texas. Now, James currently oversees nearly 4,000 units worth more than $500 million. And Achieve is a vertically integrated multifamily investment firm dedicated to acquiring and operating properties with significant value-added components located in high-growth, top-tiered MSAs. And so with that, guys, it's my honor to welcome back my friend and a real estate expert, James Kandasamy. James, how you doing today?
I'm doing great. Thanks, Kevin, for having me back on this podcast.
Oh, excited to have you back, my friend. It's always, as we were chatting before we start rolling here, it's just always good to get caught up and always get. Well, I was hoping to, to get caught up with you at Rod Cleef's mastermind event, a month or two ago. We had a big hurricane scare coming here through Florida, and so we weren't able to reconnect then. But I'm happy to have you here now, my friend, and always good to just again get back in the loop of what you got going on, because you got your hand in a lot of different pots. And so
absolutely.
we're gonna pour out those pots or dig into them today and learn more about what you got going on. But with that, I'd say let's start for maybe those that aren't familiar with you, James, that don't know who you are and what it is you do. So maybe fill in the gaps, that very short brief bio that I provided you. Fill in the gaps and tell us a little bit more about you.
Sure. Just before that, I love this podcast that you're doing. Before I get started in commercial real estate, I used to listen to your podcast when I was doing my single family, right? So that was like 2013, 2014. So thanks for adding value to me and a lot of other people. There's just not many podcasts which is high quality as yours, and I get really impatient when I listen to podcasts which has too much fluff, and 98% of them is fluff for me. So the 2% is only like 3 or 4 podcasts that falls into that category. So to talk about myself, my company is Achieve Investment Group based out of here in Austin, Texas. I'm sitting here in my office. This is a 6,000 square feet office, which we own it ourselves. And we bought this during COVID. Overall, we used to manage 4,000 units. We sold like 1,500 units at the peak of the market in March, which also mean I timed the market perfectly to take some credit out of it. But at the same time, it was a good time to sell, right? So out of that 4,000, 3,000 is existing asset. There was another 1,000 units which we are developing. A lot of it is land entitlement. We already started one ground up construction, which already moved dirt, and we're gonna be doing vertical. We're gonna be going vertical in a few months, but no, the dirt is already moved. That's a big process because that's our first ground up construction project, and it was it's very historic moment for me and my company because we did everything ourselves, right? Except for the construction, building it itself. The whole development, the architecture, planning and financing, all that I did myself. And the good part is, that's my own project. There's no investors in it.
Oh, wow.
So,
Is that multi-phase development project that you have going, or is that a different project?
Oh no, this is I don't know the multi-phase, but this is 324 units, Class A. Luxury multifamily in San Antonio, in one of the best part of San Antonio.
Yeah, I think the other one I saw that you're involved in as well is it's got some other elements other than
We are doing another 300 to 500 acres of development where we have phased development, where we do entitlement and we do ground up construction and we do stable. So that's all ongoing right now, but we're already moving dirt on a real multifamily right now. And I'm also author of 2 best-selling books. We can talk about that book. One is called Passive Investing in Commercial Real Estate. I just have it on my table because I'm giving it to my investors. And this is my second book that I just recently launched, which we can talk about it. The second book is called Smarter Doctors. You work hard, make your money work harder. And we can go into details about this book in a later while. But
yeah, and I would love to do that. It's just such a targeted title of a book, and so would definitely love to get some thoughts and feedback behind what was the original catalyst to write the book, and then what for the doctors that are tuning in, like what might they learn by grabbing a copy. And so I would love to hit on a topic though before we roll on. It's about some of the exits that you made. Obviously, you're the genius at time the market, right? No, the good thing is that I've always been told it's interesting and I'd love to get your perspective on this. It's interesting because when you're, we went through just a really frothy period of time, during COVID, and, during those frothy periods of time, like everyone knows, like things are just hyper accelerated right now. I mean, there was just capital being thrown around left and right, yet you feel that maybe we're not at the peak yet. Maybe we're not at the peak yet, right? But I've always been told, this is following 2008, is that it never hurts to take some chips off the table. Now, if you're one that has a regretful type of personality, you might look back and realize that maybe you sold in 2019 and you could have made a few more $1 million if you'd have waited to exit. But it's really challenging, nearly impossible to time the market, right? Some get lucky, some don't. And so I guess I would love, from your perspective, maybe some of the reasons behind. I mean, what was that, just the end of the cycle for those deals? Was there more strategy behind kind of targeting that point in time to actually look to divest of those particular assets? Was it IRR driven? I mean, or all the above? I just would love to learn more from you as to how you made that decision.
Sure, there's a few reasons why I made the decision to sell, almost half of my existing asset on that time. And just before COVID, I was introduced to Howard Marks. Are you familiar with Howard Marks?
I'm not, no.
Oh, Howard Marks is the Oak Tree Capital chairman. Oak Tree is one of the largest hedge funds
okay. I'm familiar
in the US. Maybe I don't know whether in the world or not, but and Warren Buffett have said that and whenever Howard Marks send him a newsletter, he will open it.
Mm-hmm.
That's the first email he'll open it. And Howard Marks is a contrarian. I mean, he's a very technical person in terms of market cycle. He also wrote one of the book called Timing the Market, learning the market strategy, and it talks about human behavior, right? He doesn't talk about, I'm the guru here, I know what's ever happening. He just talk about human behavior, because he said market is all about human behavior, right? So so he said, what is the probability of the price coming down, and when is that, right? And I realized the probability of multifamily market at peak first was before COVID, and after COVID, we went through a kind of a fluctuation, and because the government supported the whole multifamily industry, it recovered, right? I mean, otherwise, we would be in really bad shape, right? If the government didn't pay the rents for the resident, we would be in bad shape. So after COVID, I also realized, I mean, if you go to NMAC, are you familiar with NMAC? That's the National Housing Multifamily Council, where all the brokers in the country goes multifamily. And the message there was, buy whatever you see on the market. So that was a signal that Howard Mark has indicated in the book. So whenever everybody is so optimistic about an asset class, that's the time to sell. So I realized that was happening, after COVID, right? After COVID, 2022, beginning of the year, everybody buys everything. And you see the value of multifamily has gone beyond its intrinsic value. So what I mean is the real true lender out there is Fannie and Freddie Mac, right? They are the true lender of multifamily, because what they do is they only loan you when the property is giving you 25% more than what the debt service is, 1.25 DSCR. That's the true lenders. They are the long-term lenders. But what has happened is, after 2020, 21, and then 22, we have passed that threshold of 1.25. We have gone to 1 and even 0.8, 0.9 DSCR. The price have keep on going up. Even the NOI is not there. And the only way that happened was because the lender was giving bridge loans, right? And a lot of syndicators were, I mean, there's so many gurus teaching multifamily. They go and buy multifamily, and so many people buying. It was easy to raise money. People think it's endless cash flow going to come from multifamily, and everybody is doing bridge loan. So, but what has happened is, I realized people are misusing bridge loan, because a lot of deals were done were cash flowing deals. It's not even value add deals, and people are using bridge loan for. And bridge loan lender was giving out loans like crazy, because they make the fees, right? So everybody's a fee maker in between, except for the investor, which holds the equity, and the syndicator, right? Everybody else is just go and do the loans whatever you can, right? Because it's free ride. Go to NMSCs, all brokers. Everybody make money on fees, right? Nobody really look at the risk behind it. I mean, are we going beyond the intrinsic value of that NOI, right? So Fannie and Freddie completely has no business for the past. I mean, had so little business. They were really struggling. So everybody said, forget about Fannie and Freddie. We're all going to do bridge loan. Bridge loan's the smartest thing to do. There's no prepayment penalty. In fact, everybody declared Fannie and Freddie is a wrong choice for the past. And I was doing Fannie and Freddie. In fact, everybody was doing Fannie and Freddie since 2015 to 2019. Everybody says fixed rate is the right way to do it. But everybody in 2019 onwards, people said, all the syndicators said, oh, all of us made a mistake. We have so much of yield maintenance and defeasance to pay because we did yield maintenance. We did a fixed rate, right? They said bridge loan is the smarter way to do. And you can go and Google all kind of podcasts, and there's so many syndicators talking about they are so smart now doing bridge loans because there's no prepayment penalty. Mm-hmm. But they also didn't realize that they were misusing bridge loan, right? Because now you're buying a property which is beyond its potential in terms of NOI. Because bridge loan is based on DSCR of 1 or 0.1. They don't really care what's your DSCR. They will look at future forecasted NOI capture, right? So people are overpaying. So what
ends up being the fallout? Like, again, through your lenses, and some of the more risky acquisitions that might have taken place over the last 2 years. Again, and a rising tide lifts all boats, and that basically had done that, right? Had followed that pattern up until the last 6 months, right? Really, the last 6 months have been the change of course, and so. What do you do you foresee some pain, some distress that comes out
that's
of this?
already pain even right now happening. I mean, I think it's going to be worse next year moving onwards because there's just going to be, the guys with the bridge loan who has higher rates right now, right? Because now their rates has gone up to like 7-8%. Even though they have a cap, they can't, unless there are some people who are going to have a loan expiry coming soon. And where are they going to go? First of all, they bought it at high leverage. Second of all, they didn't buy it on the right value because they overpaid for it. Now the NOI is not caught up. So there's going to be quite a number of syndicators who's going to be in pain because they can't exit from bridge loan, right?
Yeah.
And I don't think so the lenders would be, going and taking back these properties, but the lenders also going to be under distress because a lot of them can't pay. Can't pay mortgage, or I don't know whether they can't pay mortgage, but they are definitely going to have hard time paying their investors the cash flow that they're promised, right? So yeah, there will be some pain. It's just how the market's going to maneuver it, right? And I did bridge loan too, but I only did one out of my like 16 syndication, right? But that was a true value add. That's like really deep value add. I know the values a lot, and we are expecting to be able to refinance that to a long-term debt. But a lot of people can't refinance into a long-term debt because you'll have a gap of leverage. So let's say you got it at 85% leverage.
Yeah.
And now you want to go to 1.25 DSCR on Fannie and Freddie, you have to take it at 55 or 65. So you have like 10 to 15% leverage gap. And I don't know how are they going to close that gap, right? So, and there's so many people out there which doesn't understand risk, doesn't understand leverage, doesn't understand the way to use the loans, the correct loans for the right product.
Yeah.
So I think there'll be some pain coming soon. I already see it right now. I already know a few deals which is struggling right now to get out, and they can't get out.
Interesting. So at this point in time, you're more. I know you've got a lot going on with these development projects. You've exited out a number of your physical assets, and are you actively pursuing physical assets you already built?
No, not really. I'm not even looking at the past 3 months. I didn't even underwrite deal. I had one deal almost going under. We got LOI accepted, but we backed out of it just because the market was not certain. But that was a loan assumption, which has a positive leverage, right? But even that I backed out. No, I'm not even actively looking. So what are we doing right now? We are focusing a lot on development stuff, a lot more on entitlement, just because I think entitlement is a quiet period work, right? So I can go into entitlement and take 1 year to get a land entitled. So this is during this time where you can't really get a good loan, I can go and do entitlement, right?
Mm-hmm.
And hopefully once the market recovers, then I can start building, right? So 2024, and I can start building some of these land that has been entitled, right? But I am thinking of coming back to the market to do existing asset.
Mm-hmm. How about the seller expectations on not existing product, but just this land that you're currently going through the entitlement process on? I mean, have you seen raw land such as that is not currently entitled have prices reset to where you could still make sense of it? I mean, is there outside these two opportunities you're working on, do you feel like there's a potential big opportunity there to go scoop up some additional land that?
No, not really. I mean, even on the
Okay.
land side, I mean, the sellers are, I mean, similar to the existing asset multifamily, right? The
Mm-hmm.
sellers and buyers still have a big gap in terms of
Gotcha.
pricing
Okay.
expectation. Even on the land, it's the same. It's just that I'm taking it so slowly. I mean, I'm not rushing because I'm not really rushing to do deals, right? As I always used to be. I do deals when I really like the deals, when I think there's a lot of upside, it's worth my time, I go and do it, right? So there's still a gap in pricing. We just wait for the right deal to come.
Yeah, no, it's the same thing. Same thing with us. It's funny. We just wrapped up our end of the year, my business partner and I, and it's the same thing. We had expectations of buying this amount this year, but really happy how the year ended up. And we bought what made sense and passed on a lot of other stuff that ultimately wouldn't have made sense. So
yeah, I mean, I don't know. Some people thinks that they have to do deals all the time.
I agree.
Right? Why?
But I think that also goes back to I think there's a litany of reasons. I think some of it's actually ego driven. I think a lot of people really get caught up in, pitching the number of units that they own and, just really, pitching activity that they're active even when others aren't. And that shows them or puts them in some type of showcase, right? That they're ultimately maybe better than that of the rest. Right. And I think so. I think ego is a big part of it. I think another part is, as you had alluded to, in another part of our conversation about, fee driven, right? I mean, just doing deals just to get the fees out of the, not necessarily looking at the longer term or viability of that investment, more so that's very short term driven, and it's definitely not in the best interest of the LPs, right? And so, and I think there's probably other reasons as well, but
there's two other reasons. I think one is as I said, who's the bigger fool, right, in the market cycle, right? So the more you buy it at the peak, you're the more, that's what Howard Marks talk, right? I mean, same thing in stock market, same thing in real estate or any other deals, any other asset class. He talks about, who's the bigger fool, right? At some point, somebody is going to take that loss because the market's going to turn and the last person is going to. So, I mean, I do not want to rush just because of that, unless I'm really confident. And Howard Marks talks a lot about probability. What's the probability of this price? Like right now, multifamily is at the highest price. Price has not come down yet. What's the probability of that going up further compared to probability of that coming down? I mean, the probability of that multifamily price coming down is higher than it's going up further, right? So then he said, don't buy. Why you want to buy? That's the time to sell, right? So he looks at probability. I mean, the issue with Howard Marks' approach is you don't do deals all the time, but that's okay, right?
Yeah.
And his concept is you don't have to get like 10 home runs. You just get 10 base runs, average runs.
Yes.
You will end up the top guy in 20 years compared to the guys who are hitting, home run, and after that they disappear and they try to hit home run again. So that is his concept, and you should really definitely look at that book called Time. It's called the Market Cycle, Timing the Market Cycle. So, and it's a very popular book in the investment world.
Yep. Okay.
The second reason I think why people are still doing deals because of LPs. A lot of passive investors have got this juice of making so much money from the syndicators. Now they're pushing all the syndicators. When is your next deal? I mean, I have a lot of LPs telling me, when is your next deal? When is your next deal? I want to invest. And, it's hard, right?
It's like they're giving the drug, right? They're giving the drug, and now
who are used to, who are used to raising money from all these people. And I was watching this episode called American Greed. That's episode in I don't know whether Netflix or HBO or what, right? American Greed, and there's one guy who who was syndicator who got into trouble, and end of the day he went to jail. And later they interviewed him. Why did you do it? Why did you take so much money even though you don't have good projects? He said, well, my investors are forcing me all the time.
Oh my gosh.
He clearly, the investors keep on forcing me. When is your next deal? And So I don't know, when I saw that episode, I just saw one episode and that was very eye-opening. And it's like, that's what's happening right now. I have a lot of investors of asking me to do deals. I said I will only do deals when I like it. And they may go and invest their money somewhere else, which a lot of them do, but that's okay. Right.
Yeah.
I just want to feel good when I do a deal.
Yeah, no, I think the other, and there's probably one other reason as well, and it's more, it is related with the LPs. It's really, pressing for some more investments, and I think a lot of limited partners, yeah, I think not just limited, a lot of us that have invested in deals, have really enjoyed the depreciation aspect of it, right? And we know that the bonus depreciation is starting to scale back next year, and I've seen a big emphasis in in this fourth quarter. And I think some investors, ultimately allow that the tax dog to wag the tail, right? The investment tail, and really looking at it, and there's strategy on both sides, but I would never ultimately make a decision just based on the tax benefits.
On the tax benefit,
no,
yeah,
right. And I think
if you're doing a deal just for the tax
do.
benefit, then that's not the right deal, right? So
no, not at all, not at all.
Yeah.
So let's go into the book. Your recent release book. Is it out now? Is it on Amazon? Where can we find it?
Yes, it's on Amazon. It's called Smarter Doctors. You work hard, make your money work harder, which I wrote especially for medical professionals, doctors, pharmacists, dentists. It's out in Amazon. You can go and look at it. I didn't do as big of a promotion compared to my first book, which is called the Passive Investing. This was launched like 3 years ago, and we sold like maybe I don't know thousands of copies of it, paid copies. Apart from whatever I give for free for my investors. So I wrote this book, the doctor's book, for the past 2 years, and for the simple reason is I have like 20% of my investor base as doctors, and they are. I mean, first of all, when I talked to them, they said, "Oh, I should have known about this investment strategy, 10 years ago." Whoever I talk to, right? Second of all, if you're talking to a new doctor who has never invested in any of these, they are bombarded with so much of financial advice. They do not want to listen to any. So they put a deaf ear to you, or they just do not want to listen to it. So how I was thinking, how do I give them the knowledge, right? And this is the only way I see if I write a book, which is a third party knowledge, right? A book is a third party knowledge, right?
Sure.
So a doctor or any medical professional would be able to pick up that book and make their own judgment call rather than me pitching them. I never pitch to my investors, right? But I think and they are very much referral driven. The doctors and a lot of accredited investors are referral driven, right? High net worth people are all referral driven because they don't have time to go and network and conference. They don't have time to go to Facebook group. They don't have time to go to meetups, to find investment opportunity. If their friends say this is a good deal, I know this guy is good, they'll invest. Right. So even so I was thinking about how do I write this book, because I want to write about passive investing. At the same time, I also want to implement referral from their friends kind of concept into the book. So this book is basically a doctor discussing among their doctors.
Okay.
And they giving advice to their colleagues, right? So I'm being more of a moderator kind of thing. So, I mean, except for the last chapter where I took what I want to say. So the last chapter is mine, but the first 6 chapters is all about doctors discussing, what is the best way to invest, what they would have known earlier. So I really want to make it like, doctors listening to their friends.
Sure.
So I wrote this book. So it came out pretty well, actually.
And have you found it to be well received? I mean, in the time that it's been out?
It was just out for 3 weeks ago when we released it. Until now, it's well received. We'll see how it goes. But as I said, books takes time.
Sure.
We are not in the business of making money. But whenever I see a doctor, I can give this book, right? Rather than telling them about, hey, have you heard about commercial real estate investing? Do we about apartment? And they're going to put a deaf ear to you most of the time, right?
Right.
So if I give them a book, they have a choice to read it, right? And
absolutely.
Within doctors, they can give it themselves. and I can go to a doctor's even give them the book. I mean, rather than giving them some general investment book, I'll be special. So I believe it's going to be a good way for me to attract more doctors to invest with us. At the same time, give them more education, right? So
Mhm.
yeah, I mean, it's just we adding value to the industry and to the community, and that's where the best investors and the best followers come for
Mhm.
us actually.
I love that. I love that. I guess continue on the topic of just investors, not
Mhm,
necessarily doctors or anyone in the medical field, but
mhm.
speaking to your expertise, it's kind of it's dual pronged. You've got you started out as like a value add multifamily investor, and now you're delving into the the development space. And I know one of the two projects is it's entirely your own money to bring any outside investors in. But I'm curious about on the that multi-phase development project, the large one on that large tract of land. Just did it take a good bit of time to educate your investors, because they know you as this one individual, but development's just a very different world than that of being a value add investor. And so were there any challenges there that you had to overcome?
Oh, there was a lot of challenges. In fact, I spent a lot of tuition fee on my own money to learn. It's money wasted, like quite few hundred thousands of money that I wasted just learning. But that's okay, right? Because this is the future, right? So yeah, there was a lot of challenges, but I'm not sure you know about Albert Barris, who
Hmm.
Rodcliffe knows in it. So I mean, when he came and gave a talk in the mastermind, he did say that sooner or later you all have to figure out how to exit syndication and go and buy deals on yourself,
Hmm.
right? Because that's the exit plan for any syndicators. I mean, a lot of your syndicators doesn't even know what's the exit plan. They just keep on doing syndication,
Right.
right? And you have investors. Investors expect you to exit in 3 to 5 years, and you're always accountable to investors, right? I mean, assuming the syndicator is a very passionate about their investment, about their reputation, and all that, right? So which I
Hmm.
am. I'm very passionate. My shoulders always heavy whenever I'm syndicating.
Sure.
So after talking to after listening to Albert Barris, he said, at some point, even though you own thousands of units, you want to look at ways to at least own 100 units on your own, 100% own 100 unit kind of thing. So putting a lot of thought into it, I was always looking for opportunity to do deals on my own, right, with my own money, which makes a generational wealth,
Mhm.
right? In fact, I'm writing my third book called Breakout, which is going to be talking about how to create generational wealth. Um, but that's the precursor there. But anyway, so what I did was, apart from this 324 units class A, I also bought a hotel and converted into multifamily, and that is something we own ourselves. That's like 170
Hmm.
units. So that's fully owned by ourselves, 170 units in San Antonio. And when we exited a lot of our asset, I was thinking, how do I take all this money and do something that I can buy myself? And that's where development come into the picture, because development is this huge value creation from very low value to very high value, right?
Hmm.
That's development. It's very high risk, but you're also creating a lot of value. So I said, I'm definitely going to do some development. So I got my investor to, I mean, one of my investors has been always asking me, saying that he has this land in San Antonio. He needs someone to develop it. And he only trusts me to develop it, to sell it to. So I said, okay, let me do some numbers. So yeah, we build up our own development team, development company.
Hmm.
We have architects, we have project managers, and it was a lot of learning experience, because it's not an easy asset or easy task to go into development, because there's so many moving parts, right? And so yeah, there was a lot of learning. We burned a lot of money, as well as we hired one architect. We completed design process. Now we have to scrap entire design and restart again. So that cost us a lot of money, and also going to a lender and getting a loan for, like, almost $60 million. This project is almost $80 million value, and the loan was almost 52 to $60 million, right? How are
Hmm.
they going to qualify me myself as the person to? So that was another challenge as well. So we are able to penetrate that challenge, able to get through it, qualifying myself, and getting a loan, getting a GC, right? Getting a GC to build it, right? So, but GC was towards the end, but coming to the point of getting a land, getting its zone, getting utilities, getting entitlement, that was almost 2 years, right? So once you're done 2 years, now I've created this value and I have my own development team. I was able to convince a lender to give me a loan, and just the process itself was very challenging,
Yeah.
especially on the design side.
Well, I don't think a lot of folks even think of it that have never done a development before. A lot of folks don't really even understand, the zoning and entitlement risk, and the cost of it on the front end. It's front loaded for that developer, and so that's, I mean, that in and of itself. Forget about all the logistical aspects that go along with getting something from raw dirt to a finished product. That in and of itself, just having the wherewithal and the means to actually do that create a massive barrier to entry. Do you agree with that?
Absolutely, absolutely.
Yeah.
I mean, if you see the real estate spectrum, there's 7 spectrum, right? First is called land banking, right? And you and I may not be in the industry that does that, but there's a lot of people who does land banking. They just buy a land and they sit for 10 years. That's called land. That's the first spectrum. Second is the land entitlement, right? Where they I mean, after they bank, now they're gonna get ready for development, right? So third is value add, right? Third is of course constructing it, right? After you do entitlement,
Improvement.
constructing it, then you do then you let it cash flow, right? Cash flowing asset, right? Then after that, you have value add, where you reposition back the older property to newer property. And the final one is called redevelopment, where they completely tear down the entire development and restart again. So there's 7 spectrum in it, right? And I know a lot of people have been trained only on one spectrum, which is the value add, right? That's what most gurus teach, right? Sure. They say buy and increase rent, and that's the value add. But if you look at it really, there's 7 spectrum, right? But if you learn the entire spectrum, there's a lot of value you can create, right? So, but mastering all the 7 spectrum is really, really difficult, right? There's no guru teaching that. And not many people have done that. So I've dedicated my time for the past 3-4 years. How do I do this, right? If I can do this, I'm creating a huge value, right? And I didn't want to bring a lot of investors with me because it's risky, right? So I said, like, I'm just going to do this myself. So that's where I started from the second spectrum. I don't like land banking because it's too slow for me. I mean, I'm not a guy who's going to buy a land and wait 10, 15 years, hoping that it's going to go up, right? But there's a lot of people who does that. I'm not that. So I say I'm going to start from the second spectrum, which is buying a raw land and entitling it, right? Go from second to third, where you do a construction, and then you go to a fourth where you're going to cash flow. So if you go for second, third, fourth, that's 3 big spectrum, which can create a lot of value within short time. And I said, okay, this will be a really big value add that you can do. And that's what I'm doing right now. I mean, but my advice is, you have to go beyond the spectrum that you're trained to, because that value add spectrum is already saturated. There's too many gurus teaching, markets at peak, your price is at peak. We are wasting a lot of time, and the chances of you becoming successful is very, very low.
Yeah.
Especially now.
I don't disagree with any of that. I had another question about the larger project, and this is maybe it's a pretty granular question, but I think it's worthy of chatting about. And so, especially given the fact that we're kind of talking as though like there's still a lot of mystery behind the development world in general, because a lot of what you and I know, or what we hang around, or what we're around at conferences, the majority have no clue about development. And so anyway, with that being said, that they understand the basic syndication model, but that's it. That's all they've ever been taught, because that's what everyone's teaching, right? And that's where the easy money was for the last 10 years. And with all that being said, speaking to this again, this multi-tiered larger project that you have, I saw that on the marketing material. You kind of have phase 1, phase 2, phase 3. Phase 1 is going through that entitlement process. Phase 2, I believe, correct me if I'm wrong, there's 3 phases, but I guess the question revolves around those different phases. There's a different level of risk for limited partners. And so would love to just, you don't have to go into super detail, but just better understand who that investor is and how are they better compensated in phase 1, given that they're taking more risk, versus the individual that comes in at phase 3, which is fairly de-risked given the length of time and the maturity of the project.
Absolutely. That's a really good question. I mean, I'm glad you asked it, because I mean, the lot of times the way I structured my deal is something that I thought about a lot and came up with it, right? So I realized, I mean, I have 7 spectrum, and I've realized my investor base has many different risk level, risk appetite, and some of them are exposed to land entitlement, some of them are exposed to just cash flow, right? And some of them are okay to be in between, right? So
Mm-hmm.
so I've realized my investor appetite is a lot, and chapter 2 of my passive investing book talks about that, right? I mean, you have to really see where you are in your life cycle to really see what kind of investment you're going to make. So I made it very clear to different people when I, not even before I talk to investors, I was thinking, how do I do this deal? Do I buy, I mean, to do deals which make sense for the past 2 years, you have to start from, you can start from really entitlement because that's where the value is the lowest,
Mm-hmm.
right? But there's also higher risk, land entitlement, higher risk. So I know when you're higher risk, you have to pay them more, right? So with the way we structured phase one, which is the entitlement, we give them like almost 25% preferred return. Because I said, okay, high risk, you're going to do entitlement. It's going to be paid at one lump sum in 2 years or 2.5 years or 3 years. We are okay to put preferred return as high, but we're also buying the land as low price, right?
Mm-hmm.
So we are taking a huge risk as a sponsor, as a syndicator, by giving a lot more money to the investors. But we also said we can roll over the phase one investor can roll over to phase two where we're doing construction. During construction, the risk become lower, right? And the final phase, which is where it's cash flow, the risk is the lowest, right? And they are investors who said, I will never do phase one and phase two. I only want to do phase three. And they are
Mm-hmm.
investors who are okay to do phase one and phase two because they know the risk is higher and we have mitigated the risk and they know our team, right? So not every investors want to do each phase, but each of them does want to come into different phases. The second thing, if you look at it, right, the way you make more money, like in a multifamily where you only come in phase three, where it's already built, class A, you're going to go next 5 years, right? So you're making 8%, 8%, 8% per year. It's a very linear, non-compounding interest, right? But when you split into 3 phases, phase one and phase two, let's say you give 25%, but that's only 2 years, right? And when you move from 2 years to another 2 years, that 25% is going to compound for another phase two return.
Mm-hmm.
So the return that you're going to make in 5 or 6 years in this kind of phase approach compared to another return on multifamily for 5 to 6 years, it's going to be at least almost double or at least 50% more than what you make on a normal multifamily. So there are investors who are willing to take that risk, right? So you have to look for that kind of investors. But as long as you structure it correctly
Mm-hmm.
and you're buying the land at very low price, which gives some buffer in case something doesn't go right, you can always sell it on a land banking basis. We have confidence that we can meet that. But it's a big risk that syndicators take. But the way we have structured it, the way we tell our investors, hey, this way, you have a way to exit, or you can roll into the next phase. We also thought about how do you avoid paying capital gain tax when you go from phase one to phase two. So that's something that we have been discussing with our CPA, and there's a way to do that where you roll over from one ppm to another ppm to you have add-on ppm coming in, right? So in this case, you're not paying capital gain tax when you exit phase one to phase two, phase three. So all in all, is a very, very sophisticated structure that I came up with. I'm not sure whether other people are doing it, but I came up with. I've seen now some other people are doing it, but when I started with it, I said this is one of the best way to structure a deal because it's very, very beneficial for investors. Where based on risk, they get different compensation structure. At the same time, they can roll over and save their capital gain tax as well.
Yeah, no, I love that. I love that. Very interesting. And I guess the question would be, what was the traditional way that you saw a lot of these phased projects completed? I mean,
Traditional way, you buy from entitlement and then you wait until cash
right,
flow, then
right, right, yeah, right. I got you. Yep.
which is more, which is not the best way of doing things, right? So
Yeah. Well, tell me what James's crystal ball looks like for 2023, and I guess more related to, we talked about maybe some potential distress over the next couple of years, but I guess just market volatility, uncertainty with the Fed, uncertainty where rates are going to be, and how does one, again, you've got your hand in a couple projects here, just I guess what is your strategy to ensure that you keep your risk profile as low as possible, and that you protect your money, your investors' money here, moving into the next couple of years, just not knowing what's going to happen.
Yeah. Apart from whatever I talked about in our construction, where we're doing some entitlement work, we're just continuing with our 324 units construction. That's going to take 2 years from now. That's already in flight right now.
You broke ground on that already, or?
Yeah, we already broke ground on
Oh,
that.
okay,
Yes.
okay.
Yeah,
Got it.
we already broke ground, moving dirt. So that's going to take 2 years for it to build up. We're looking at a few other entitlement work. But on existing asset, I want to really make sure that I do really good property management and asset management to make sure it cash flows. So we are very much focused on that. And but buying deals, I'm not really motivated to buy any deals for the next 6 months. I don't. Let me take that back. I'm not motivated to buy any normal deals,
Yeah,
right?
right.
I want to buy. So I'm looking at ways that I can take advantage of this situation where syndicators need help, right? Where do they need help to go from bridge loan to fixed rate loan? So there is a gap in leverage that they need to fix, right? So I'm looking at ways to, is there a way that I can go and help them at the same time, make some money for my investors?
Sure.
So we're looking at, some gap funding, some rescue capital and all that. If I can do that, right? But I'm not going to be buying any normal deals because, as I said, I'm not a guy who really rush to buy deals or keep on buying deals for just for the fee sake. We don't really need that. I rather want to do deals where it's contrary to the market, right?
Yeah.
So deals which is struggling. In fact, I'm looking at some distressed deals. That takes a lot more of my time doing some research on distress. How do I find distressed deals, right? And during COVID, I tried that. During COVID, I set up this gap funding, rescue capital funds, and all that. After that, nothing happened, right? So,
Yeah. The economy seemingly got better.
well, it got better because the
I know.
government came and rescue
Yeah.
everybody, right? So,
Yeah, no, it's funny. I just remember thinking back to, March and April of 2020, just kind of the strategy with our team of like worst case scenarios, what was going to play out. People weren't going to pay and this, that, and the other. And, we had a few obviously selective folks, just like everyone did, that chose not to pay, tried to work the system. But, for the most part, it was not the doom and gloom, nowhere near. We
yeah, I
had
know.
anticipated.
Nothing happened, right? So, in fact, the prices went up after that, right? So,
Yeah, yeah.
um, so I'm thinking along that line. How can I do something that play with the economy, right? Not to say I don't want to do deals. I want to do deals, but not buy the normal deals, right?
How about
How do I go and
the
help?
hotel to multifamily conversion? Yeah, it sounds like you got a good one there that you took down yourself. I mean, and
Right.
I know there's a couple other operators. I don't top of my head. I've seen a few come across like Facebook or Instagram. Folks are out there doing number of conversions on hotel to multifamily, which depending on the markets in locale, there's probably still some smaller hotel operators that just haven't been able to rid the pain that they went through a couple years of COVID. But I mean, was that, I guess, asking the question of the conversion that you did, that you took down yourself, was that a distress deal? And if it was it a result of COVID?
That was a result of COVID. Yeah, it was a distress deal. So the hotel operators had like 17 hotels, and they were like giving some of it back to the lender. And
Mm-hmm.
yes, I mean, I asked them, um, you know, um, why are you selling? And they say, well, we keep on selling when we can, right? So yeah, they were in distress mode at that point of time.
Okay.
um, but the hotel that I did was very unique hotel. That's not really like a hotel. That's more like a build to rent, single family rentals kind of thing. It's not really a hotel.
Okay.
Even though they ran it as a hotel, it's not really a hotel. So not all hotels are convertible. It's very difficult to find hotels
Yes.
that are convertible. And I tried looking for more after that, and it's just so hard to find it.
Right.
Or the prices doesn't make sense, right? To go through that entire pain of
Mm-hmm.
zoning. It took me 10 months to close that hotel, right?
Wow.
So
Wow. Okay.
it's crazy, right? So, but we got it leased up in 1 year, and we're going to be doing a refi right now. We're in
Okay.
the process of doing that. But
Fantastic.
I probably have another hotel to convert that I may fall into my lap, you know. But that'll be a good niche to do if you can find the right price point.
Right. Yep.
Um, but as I said, not all hotels are convertible, and it's not an easy task to do.
Mm-hmm. Well,
But that's
Dane,
another thing that I want to
yeah.
see whether I can find deals or not, right?
And
So.
and somewhere between all that, you're going to find time to write a third book, right?
Yeah, book writing is like takes, I mean, I always say we want to do it in 6 or 8 months, but it always take 2 years because, we are, I mean, I'm so busy with deals and, we are, we keep on pushing,
Yeah.
postponing the next chapter to next week. And
Yeah. That's what happened to me. I got like 90% of my book written in probably in about an 8-month, 9-month period of time. And then it fell off the list as a priority. And then it went 2.5 years before we finally launched it. So,
but you did finish your book, right?
I did. Yeah. I launched it in April, but it ended up
Okay.
being almost a 3-year project. But
3 year
again, like
project.
I said,
Yeah.
I
That's common.
got it to 80 to 90% completion, within the first like 8 months. And then it just, again, it just wasn't the top priority, and it
Correct.
was always, but it always nagged the back of my mind. It was always there, right? It was like the weight on the shoulder of like, I put this effort in here, we spent the money, the resources, the energy, all that to do this, so we got to get this out there at some point in time, and sooner rather than later. And so yeah, so we launched it in April,
Yes, that's good.
or
That's
April of
good.
this year, April of this year.
Congratulations. Yeah, it's the last 90, the last 10% is always hard, right? Like my third book, I'm at the last, I already done 90%. The 10% is where it's hard for me to finish it.
Yes. Well, James, it's always fun having you, my friend. It's always fun bringing you on and catching up with you. And, guys, I'll put links to both of his books in the show notes. And then, James, for those that want to learn more about you and your investment group and any projects that you have going, or just stay abreast of what you have happening, where's the best place to find you?
Yeah, my best place is achieveinvestmentgroup.com. That's my website. You come in and you find somewhere to, either register as an investor or register as a newsletter. Our newsletter is being read by almost 4,000 people every week.
Oh, wow. That's great.
Yeah, we spend a lot of time writing high quality content on it. So yeah, our open rate is almost 50 to 60%.
Fantastic. Well, congrats, my friend. No, that's I mean that's an testament to just what it is you do and the quality information you put out there. So
Yes,
again, always appreciate having a conversation with you. It's always enlightening. And yeah, no, absolutely. And wishing you all the best and success in 2023. And we'll bring you back on at some point here in the future. We'd love to keep on top of those development projects. And you broke ground on the one and got the other one working through the entitlement process. But would be fun to do like maybe a follow-up show or two down the road and just kind of follow them along if you would.
Yeah, absolutely. Let's do that.
All righty. Good deal. Well, James, you take care. Okay. Happy holidays, you and your family.
Happy holidays and happy Christmas. Merry Christmas.
Alrighty, guys. That's all we have for this week's show. And so until we meet again next week, this is your host, Kevin Bupp, wishing you huge success. Take care.